Good morning, everyone. This is Jay Jordan, and on behalf of all of my teammates at Heritage, I want to welcome you to our third quarter 2022 Market Outlook webcast. I'm joined on the call today by Carrie Baronian, our Director of Research, as well as the newest member of our team, Steve Henderson, who is our Director of Private Investments and Foundation Strategies. A couple of housekeeping items before we get started. We plan to have a question and answer session after our prepared remarks. So to ask a question, you can click on the Q&A button at the bottom of the screen at any time during the call to send us your question. A replay of the call will also be available on our website starting likely tomorrow or this afternoon. So our agenda for this morning is to pull up the slide. Our agenda for this morning is to discuss the shifting macroeconomic backdrop and the implications that has as it relates to inflation, monetary policy, and economic fundamentals. Then review the resultant financial performance that we've seen based on some of those shifts, discuss fundamentals from both a valuation and a corporate earnings perspective. And then Carrie's going to take us through the portfolio positioning of our Heritage client portfolios. And then Steve's going to give us some high-level remarks as it relates to alternative investments and the role that they play in portfolios. So let's get started. When we entered this year, we had a healthy level of skepticism that the drivers of returns in the economy over certainly the past 2 years, but honestly the past decade could persist. And specifically thinking about the extraordinary liquidity that had been placed into the market, the degree of fiscal stimulus that had been placed on top of monetary stimulus, and the resultant strong earnings growth and aggressive investor attitudes in terms of their views of risk. In an environment where our view was that rising inflationary pressures coupled with stretched valuation really across all asset classes was creating an imbalance as it related to the level of risk in markets relative to the potential return opportunities within markets. That uncertainty really had us positioned in a way that we've been biasing portfolios heavily towards quality over the course of really the last 18 months. And we took an additional step as we began to see additional pressures in the economy to take risk out of the portfolio earlier this year. At the same time, we've been leaning heavily against speculation in certain areas of the market as a way to continue to insulate our portfolios and insulate our client portfolios against what we believe to be building risk in the markets. As we look forward, we've taken some steps towards normalization in the market, but continue to believe that there's still another step within the market that we need to focus on as we think about capital market returns. But as we move through this period of market volatility, we do believe that we're in an environment where we will ultimately, as we come out of the other side, with a portfolio that remains biased towards quality, we will ultimately be seeing opportunities to move back into certain areas of the market where we can ultimately generate higher expected returns for clients. So to move into some of the specifics about the economy, if you look at this slide, when we came into the year, the narrative around inflation was that inflation was transitory. And I think that we put that to bed over the course of the last 6 months. Certainly, if you look at the most recent prints from a CPI perspective, reported CPI was up 9%, which is the highest level of inflation over the last 40 years. Core CPI up 6%, also the highest level of inflation over the last 40 years. But these are both cyclical in nature, but also structural in nature. We've talked a lot about supply chain issues as part of the reason for inflationary pressures, but there are also structural inflationary pressures in play. Labor markets remain very, very tight. The housing market remains structurally undersupplied. And even when we look into the natural resources and commodities areas of the market, we've been at about a 7-year period where we've starved commodities, including the energy sector, of capital, which has resulted in a structural undersupply of natural resources. At the same time, what we see as a result of this rising inflationary pressures is a clear shift in the focus of the Fed. The Fed has a dual mandate of full employment and maintaining price stability. Now, we have relatively full employment, but price stability, given that we're at 40-year highs in terms of inflation, has become an increasing focus for the Fed. And I think it's important to think about why it's become a focus for the Fed. And really the reason it's become a focus for the Fed is that when you think about inflation, ultimately inflation is a tax on 100% of the population, and it's a highly regressive tax. It hits lower income sectors of the economy much more severely than it does higher income sectors of the economy. And so the Fed is clearly focused on changing the narrative from being behind the curve to catching up to, to continue to move towards price stability in the markets. While cyclical inflation may be peaking, I think it's still important. We're a long way from a 2% target inflation. And so our expectation is, and this has meaningful implications for both Fed policy, as well as interest rates, as well as earnings for the economy. And if we turn to the next slide, our view has been that the Fed has been behind the curve. Now, what this chart shows is that the dotted lines show the current dot plot expectations from the Federal Reserve. The solid lines, the green line shows the current expectations that the market has for interest rate policy as it relates to the Fed. And certainly what you can see through this graph is that, the market's expectations are that we're about halfway through the Fed tightening cycle in order to ultimately arrest price pressures. And, the Fed is really walking a bit of a tightrope here as they try to slow the economy, because, our view is that inflation, while it is a supply issue, it's not simply a supply issue. It's also a demand issue, given the excess demand that was introduced into the economy over the course of the last 24 months. Again, due to excess liquidity, excess fiscal stimulus, the Fed is attempting to curtail demand to bring back into balance the supply-demand relationship of for prices in the economy. Now, current expectations are that we're about halfway through rate increases and it will peak somewhere around 3.5%. The yield curve is certainly suggesting that the Fed will ultimately be successful in slowing the economy. You can see that the yield curve is now inverted between 2 years and 30 years. But our view here remains that we think that the outlook for the economy, the outlook for markets is going to be path dependent. The Fed is going to continue to move to increase rates until we see a slowdown in the economy and the resultant relaxation of price pressures in the overall market. So if you turn to the next chart, I think you can see that the increase in interest rates and the tightening in financial conditions is beginning to have an impact on the economy. This is a chart of leading indicators in the economy, and what this clearly shows is that the level of economic momentum in the economy is slowing. I think you can look at other examples of leading indicators in the economy. For instance, if you look at industrial manufacturing orders, they're now in contraction. If you look at housing, and housing is really, we think about housing as really being the tip of the spear as it relates to monetary policy. It is the primary transmission mechanism for monetary policy in the economy. And if you look at what's happening in housing, while from a secular perspective, we still believe that the housing market remains undersupplied. From a cyclical perspective, we are seeing the impact of rising interest rates on housing. As an example, if you look at the average mortgage payment over the course of the last year, the increase in home prices combined with the rise in interest rates has resulted in a doubling in the cost of an average monthly mortgage payment. That goes back, as you think about that as a percentage of income, that equates to the peak levels we reached back in 2007 during the housing bubble. You're also seeing cancellations, contract cancellations, for instance, in June were at 16%, which is up from about 10 to 12% in more normal times. And so we believe that we are seeing the impact of tightening financial conditions. And that continues to support our view that if we're not already in a technical recession, which is defined as 2 consecutive quarters of negative GDP growth, we do believe that the probability that we are moving towards, if not a significantly slower economy, a recession, that probability is certainly rising. And that has meaningful implications as we think about how we move forward. Now turning to the next slide, markets have clearly reflected the headwinds that we are facing. If you look at the equity markets, the first half of 2020 was the worst period in 50 years, in financial returns, with the S&P 500 down 20%, small cap stocks or technology stocks down even more than that, and small cap stocks also down more than that. Similarly, if you look at where we were from a fixed income perspective, bonds have not been a place to hide. If you look at the traditional balanced portfolio over the course of the first half of the year, this has been the worst period of returns for balanced portfolios on record. If we look back as far as we have, the aggregate index for the bond index, as interest rates have gone from 1.5% to 3.5% in a relatively short period of time. And so as we look forward, I think it's important to ask the question though, where are we in terms of, the big question, are we there yet? Given that we've had this significant decline in equity prices, we've had interest rates move back towards more normal levels. Are we in a period now where we have an opportunity to earn excess returns? And I think that's where we continue to be of the view. We've had our clients positioned in a highly quality biased portfolio that has worked out very, very well. Our clients have held up. Our client portfolios have held up well in a very challenging environment. But the real question becomes, where do we go from here? And I think if we look at the next slide, I think what's important is as we begin to move towards a more normal environment, what's happened to date, we would really define as more of a valuation correction as opposed to changing fundamentals in the underlying earnings expectations of the market. If you look at this chart, what this chart shows is the green line is price performance of the S&P 500. The black line is actually the earnings growth of equities. And you can see that over the course of the first half of the year, earnings have actually grown about 7%. Now the market's down about 20%. So what that shows you is that the compression in valuation multiples from relatively high and historically high levels back 12 months ago to today has resulted in multiple compression. So we've gone from about 24 times earnings on the S&P 500 down to about 16 times earnings on the S&P 500 today. That's a normal adjustment in an environment where we've taken the discount rate or interest rates, which have gone from 1.5% or even less than that 18 months ago to 3.5% today. So the discount rate that we use to determine the price that we would pay for a future dollar of earnings has risen. That results in the market bringing down valuations. But the real question is, as we go forward, is where do we go from here? So if we move to the next slide, what we can say is that we have taken a meaningful step towards normalization. Valuations are now at, looking back over time, at 16 times forward-looking earnings expectations. We do believe that we are, back in a more normal environment for valuations, and we have removed some of the excess speculation out of the market. I mean, you can look at for instance, some of the beneficiaries of the stay-at-home environment back in the midst of the pandemic. You can look at some of the meme stocks that are now down 60, 70, even 80% from their peaks. But we are now in a position where, as we look forward, we can begin to think about, one of the upsides of valuation is that ultimately more normal valuations suggest that we have that long-term return expectations begin to move towards a more positive scenario. So the question is, where do we go from here? And I think that if we turn to the next slide, here's where our challenge is as we look forward, because we're certainly paying a lot of attention to high quality businesses and invest in where we believe that earnings expectations are moving towards more realistic levels, and where valuations certainly are at more attractive levels that suggest that we may ultimately get opportunities to continue to buy high quality businesses. Similarly, in the credit markets, we've seen spreads back up to some degree, which may ultimately provide opportunities. But our real challenge right now is that we still believe that there's a disconnect. And there's a disconnect between the fundamentals of the underlying economy and earnings expectations. And our challenge is really this: in an environment where economic trends are clearly slowing and where margins are at peak levels, and cost pressures are building, as we think about inflationary pressures building, both wage inflation as well as supply input inflation are building in the economy. It's very challenging when we look at the overall earnings expectations of the market, which still suggests that we're looking at double-digit earnings growth for this year, and then high single-digit earnings growth for 2023. It's very difficult for us to come to a view that earnings expectations, which ultimately are going to drive returns from here, appropriately reflect the underlying fundamentals of the market and the underlying fundamentals of the economy. That continues to place us in a more defensive posture, continuing to be biased towards quality, continuing to stay biased within credit markets towards higher quality. And that's based on a view that we expect to see a significant adjustment in earnings expectations over the course of the next 12 to 18 months. If we do an exercise over the entire market, where we think about what normalized earnings for the market would be. Because one of the things that we know is that we can look back over a long period of time, and earnings ultimately follow the economy. And you can look at a 10-year, 20-year, 30-year period of returns for equities, and earnings growth over that time frame averages somewhere between 6 and 6.5%. And if you think about, like, as a long-term investor, you're valuing businesses based on normalized earnings. And when we normalize earnings for the market today, what we believe is that on a normalized basis, earnings power for the market is somewhere between 190, and for the market being the S&P 500, is somewhere between 190 and $200 a share. When we place an appropriate multiple based on current interest rates of around 16 times on that multiple, we end up with a market where we believe that fair value lies somewhere between, call it 3,200 and 3,500 on the S&P, versus today we're at around 3,900 on the S&P. And so we continue to believe that from a broad market perspective, that there is risk to underlying earnings, there's risk to prices in the market. And we're going to continue to focus our client portfolios in areas of the market where we believe that we have achievable earnings expectations, where we also believe that valuations appropriately reflect the potential risk of the overall market. So with that, I'm going to turn it over to Carrie to talk specifically about our positioning.
Yeah, and so as we discussed on our last call, we've been in the camp for a while now that risk-reward characteristics in financial markets have been skewed to the downside. And so that's really influenced us over the past 12 to 24 months to position client portfolios accordingly and take numerous steps to lower the risk characteristics of client portfolios. And as our views of the economy and financial markets have played out, as Jay alluded to, our client portfolios have held up very well against the market volatility. And given the backdrop that you just described, Jay, we continue to believe that taking a more cautious stance in client portfolios is appropriate. So we continue to manage equity allocations below long-term targets while holding an above average level of cash. This chart shows compared to a strategic asset allocation that's 65% capital growth, 32% fixed income, and 3% cash, we're currently managing the portfolio at about 59% capital growth, 25% fixed income, 9% alternatives, and 7% cash. If we turn the page, from an asset class perspective, we continue to own our concentrated leaders portfolio as the core of our equity exposure. This chart shows the logos of the holdings in concentrated leaders. You can see the portfolio continues to consist of 24 U.S. large cap names diversified across sectors. We continue to believe that these businesses are very high quality with durable competitive advantages, strong growth and income characteristics, and trading at reasonable valuations. We continue to have confidence in their ability to weather any type of environment and generate acceptable returns over a full cycle. As we discussed on our last call, we have taken steps, a couple of adjustments to enhance the risk reward characteristics of the portfolio. And the portfolio has held up very well against this market volatility. Just to give a couple of examples, we took profits in ConocoPhillips, which had outperformed as energy prices spiked to multi-year highs. And we reinvested the proceeds in Johnson & Johnson, which we continue to view as a high quality business, more defensive characteristics, and trading at more reasonable valuations. We also reduced our exposure to financials, which had outperformed and we believe may face a more challenging path forward. For example, we trimmed Berkshire Hathaway and Progressive, and then we reduced or removed Truist from the portfolio. Would say that overall, we believe we continue to have a collection of really great businesses here with balanced exposure to defensive, cyclical, and growth areas of the market. If we turn the page, staying within domestic markets, we remain on the sidelines of U.S. small cap. This chart shows the percentage of stocks in the Russell 3000 trading at price to sales ratios greater than 10 times. You can see the percentage has fallen, but is still residing above tech bubble levels, which to us suggests that valuations are still unattractive. Additionally, we continue to see challenges from a fundamental standpoint related to U.S. small cap. While we believe that U.S. small cap should benefit from some trends such as stronger dollar, potential shift to deglobalization, because they are more U.S. centric businesses than U.S. large cap, which tend to be more multinational. We do believe that U.S. small cap should be disproportionately negatively impacted by other trends. For example, higher inflation because their pool of available labor and capital is more limited, higher interest rates because they tend to be more leveraged businesses, and then also potential recession because they tend to be more economically sensitive businesses. We turn the page and focus a little bit overseas. We can see here we continue to manage international equity allocations below long-term targets. We believe that international markets face many of the headwinds the US does, but of a greater magnitude. This chart shows the European manufacturing PMI, which represents manager expectations for European manufacturing activity. You can see it continues to roll over and has fallen below 50, which suggests that or signals that expectations for European manufacturing activity are expected to contract. As we discussed on our last call, from a positioning perspective, we took steps to reduce our exposure to the BlackRock Global Dividend Strategy. Because the fund emphasizes dividend growth, it naturally has sizable allocations to financials, industrials, and other sectors that are often the first to come under pressure in a slow growth, weak economic environment. We view reducing our exposure to BlackRock as a step to lean against international markets and these specific sectors. If we turn the page, can see we continue to hold a position in natural resource equities. As you all know, we purchased the GMO Resources strategy in 2020, which invests in global commodity producers in energy, industrial metals, and agriculture. This chart shows the valuation of resource equities relative to the global equity index. You can see these stocks are trading at a discount to the index versus historical average. You can see on the far right side, the line has started to hook upward, but it's still below average, which suggests that valuations or relative valuations specifically are still attractive. We recognize that these resource stocks definitely would not be insulated in the event of a cyclical slowdown. But we would also say, we continue to believe that these businesses should benefit from other secular trends. For example, persistent underinvestment in new supply, robust demand given the ongoing urbanization of emerging markets. Certainly industrial metals are very key inputs to energy efficient vehicles, et cetera. So we continue to view the long-term growth, income, and diversification potential of these stocks favorably. We turn the page, within fixed income, we continue to prioritize high quality short and intermediate term securities. As we discussed on our last call, we reduced exposure to preferred securities and reinvested in core bonds, which are high quality and offer a more compelling yield following the backup in interest rates. And we remain short duration in anticipation of a continued pickup in rates. What this chart shows is high yield credit spreads, and high yield credit spreads represent the estimated incremental return investors can expect to receive for taking incremental risk in the below investment grade bond market. You can see on the chart that spreads have increased, but they're still residing below levels seen during the bursting of the dot-com bubble, the 2008 global financial crisis, and the 2020 COVID sell-off. We therefore continue to rather take economic risk in high quality stocks, but would also say if spreads continue to widen, we may identify an attractive entry point to invest. As we discussed previously, we continue to hold an above average level of cash in client portfolios. Really continue to believe that cash is a very important asset class in terms of supporting future investment needs, or excuse me, future spending needs and investment opportunities. given more compelling yields, we did purchase short-term treasuries as a cash management solution for a portion of our cash allocation. And as we've discussed previously, especially during prior drawdown periods, one of the very few good things about a pullback in asset prices is otherwise higher future investment returns. So, really continue to review our holdings in the markets broadly to try to identify opportunities to upgrade quality at attractive valuations. And then if we turn the page, one final asset class to hit on, we did build an allocation to gold to help preserve capital in an inflationary environment and hedge against policy uncertainty. You can see with the chart, while the price of gold has consolidated, in the face of a spiking dollar, it has done that this year, but we really continue to view it as an important long-term allocation in client portfolios.
Great. So thank you, Carrie. So now I have the pleasure of introducing everybody to the newest member of our team, Steve Henderson, who is our Director of Private Investments and Foundation Strategies. Steve comes to us from Spider Asset Management, which is the management company responsible for the University of Richmond Endowment, where he spent 10 years as their Director of Investments. And prior to that was at the Virginia Retirement System. And so I asked Steve to spend a couple minutes and talk about just the role of alternative investments and that they will play in, that they do play in client portfolios.
Great. Thanks, Jay. Great to be here and looking forward to meeting everyone on the call and working with you over the coming months. Alternative investments. So that's a wide range of things, right? It really means everything from sort of private credit to long short strategies to venture capital, with stuff in the middle of all of that. And why would anybody want to invest in those things? There's really two primary reasons. We saw this play out at Spider quite a bit. Number one, and importantly, it's to enhance returns, but equally importantly is we view them as a way to control risk and actually reduce risk in the portfolio. And that might sound counterintuitive to some, but the evidence is pretty clear that the diversification benefits and the lower correlation to the public markets does provide that kind of risk reducing quality to alternative investments. One of the keys, of course, is investing with the best managers. There's a lot of them out there, and it's incumbent on us to find the best ones and to invest your money in the best ones. The looking can be easy, the finding can be hard at times, but certainly coming out of Spider, we think we have a pretty healthy list of attractive GPs. Where are we today? You just seen charts and heard the story about wider high yield spreads and PE multiples coming down, and that's of course true, and that does have an effect on the private markets as well, but it's not as much of an effect. And the S&P being down 20% for the first 6 months of the year. We'll see what the private marks on things like private equity do for the first 6 months of the year, but it'll be less than that. Why would it be less than that? It's mostly because they don't write it up as much either. So it's kind of slower when the market, does really well and multiples expand, and it's also slower on the way down. So that's sort of one of the ways it reduces the risk in the portfolio. So I would imagine the private marks that Spider sees and other big endowments see for the first half of the year will be less painful than what they saw in the public markets. Like you heard on the public side, though, we're looking for the right opportunities to get into these markets, and you have to have a long-term view. There is no perfect way to time the markets, but the opportunity set is sort of attractive now, but we think it's going to get more attractive over the next couple of years, and we want to be ready for that. So what are we doing? We're starting the process here at Heritage of having lots of meetings with GPs, understanding who's fundraising, understanding who the people are, exactly what their strategy is, because ultimately that's what we're doing, making a judgment on people and their process for creating value. And these markets are less dependent on spreads coming back down and PE multiples going back up to generate value. They're more about operational improvements at various companies and creating value that way. There's also the notion, and I'm just going to say it briefly and we'll talk more about it, but there is good leverage and there's bad leverage. So some of these strategies do employ leverage, and when it's done prudently with quote unquote good leverage, it really can create a lot of value. So a lot more to come. We look forward to having the conversation with all of you when the time is right, but we're getting the plumbing ready here to make those sorts of investments. So
Great.
Jay, turn it back to you.
Awesome. Thanks, Steve. So just to sum things up, we continue to feel, have a high level of conviction in the positioning of our portfolios with a bias towards quality, given the continued uncertainty that we see as it relates to the economy. And again, a disconnect between where we see expectations and where we see the underlying fundamentals, both of the economy for corporate as well as corporate earnings and credit spreads. So we feel very good about the way that we have our clients positioned. We're pleased with the performance to date, but we also recognize that as we work through this transition, as markets normalize, it is going to create opportunities to generate stronger expected returns for our clients moving forward. And we're actively assessing those opportunities as markets move through this transition. So we appreciate everybody's time. With that, I'm going to turn it over to the question and answer part of our webcast. And I will start. We have a few questions, but maybe as a starting point, Carrie, I'll ask you as we think about the positioning. One question was, if we're in a recession or technical recession, which industries would fare best?
Yeah, I would say in that environment, it tends to be the industries and sectors that have the most durable demand and aren't as economically sensitive, aren't as reliant on discretionary spending. And so maybe examples of those would include healthcare, consumer staples, utilities. So those businesses we would say might hold up better from a profitability perspective. But when it comes to how their stocks might perform, we would want to point out that today, those businesses are actually, in our opinion, priced accordingly to behave better. And that means, still pretty high valuations compared to historical average. And so again, while the profitability of those businesses might hold up relatively, we wouldn't say that they would be, entirely insulated from a pullback either.
All right, the second question is, are T-bills still attractively priced considering the other short-term alternatives? You want to take that? I think, I'll piggyback off of Carrie's point from earlier, which is that we do believe that, in environments like the environment that we're in today, that cash is an asset. When we talk about cash, we're not just talking about cash in terms of banking account or checking account. We are talking about short-term treasury bills as well. And we're in an environment right now where, a 1-year treasury bill yields about 3.1%, which, if you think back over the last decade, one of the acronyms that was coined over that time was TINA, which was that, the reason that stocks kept going up was because there was no alternative. There was no yield in fixed income. And so there was a rationalization for paying higher and higher prices for equities. Well, there is an alternative now with treasury bills, a 1-year treasury bill at 3.1%. And we do believe that in an environment of uncertainty, the optionality value of cash as it relates to future opportunities in an environment where you can get paid over 3% does suggest to us that there is value at the short end of the curve. And that's really where we have quite a bit of our exposure, more than normal exposure as it relates to fixed income. All right, the next question is, how are earnings being reported thus far in the third quarter relative to expectations? We just had this conversation earlier this morning, so I'll let one of you guys take it.
Carrie.
Yeah, it's funny. We were just talking about it this morning. At the start of this week, I think about 10% of the market capitalization of the S&P had reported so far this season. And based on what we're seeing, the reports have been modestly higher than expectations, not material in our opinion. What we're paying attention to is what management's saying in terms of forward-looking guidance. And we have seen forward-looking guidance come down a bit. And to us, that really supports our view that we might be in the early innings here of a pullback in corporate earnings with still time for the impacts of inflation, higher costs, potentially weaker demand to find their way into the P&L of companies.
Okay. The next question is, what do you see happening to the value of the dollar, and how does this impact gold, resources, commodities? And maybe I'll take a stab at this, and then you guys can jump on and add to it. But it's interesting because if you think about where we are from the value of the dollar today, the dollar index, which is the dollar against a basket, you see a lot of press about the fact that the euro has reached parity relative to the dollar. But the dollar index, which is the value of the dollar relative to a basket of currencies around the world, is within a couple of points of where it peaked in 1985, where the value was high enough that we had the Plaza Accord, which was a meeting of central bankers around the world that was where the objective specifically was to push down the value of the dollar because of the negative impact it was having around the world. And I think you can make some correlations between that period and today, because what's happening with what's interesting in terms of the question around how does it impact natural resources is that we've been in an environment where a rising dollar should be have a disinflationary impact on the economy, on the domestic economy. And in fact, we've had a spiking in inflation pressures and rising commodity prices in the face of a rising dollar. Now, there are a couple of reasons for that. Kerry's talked about the structural dynamics of the natural resources markets, where we have been essentially starved them of capital over the course of the last 6 or 7 years, and we have a mismatch from a supply demand perspective as a result. But I think that importantly, when you think about a rising dollar, while it is disinflationary in the U.S., it is inflationary around the rest of the world. And that's really where we have some clear concerns. And Kerry spoke to our underweighting, our very modest weighting in international markets, because what happens with a rising dollar and rising inflationary pressures in the rest of the world is that it creates volatility within the underlying sovereign debt markets. And if you take Europe as an example, the banks in Europe their balance sheets are heavily exposed to the debt of the sovereign debt of European countries. As you get volatility within the sovereign debt markets, with interest rates rising, that creates a negative capital impact on European banks, which creates a cycle where then credit pulls back out of the economy, and you create almost a negative feedback loop as it relates to the overall economy. So our concern with a rising dollar is that it's likely to have a negative impact on international markets, maybe more so than the U.S. market. The U.S. is, for lack of a better term, it still remains the cleanest dirty shirt in terms of economic fundamentals. The Fed, rates and interest rates in the U.S. are still above. The ECB today raised rates 50 basis points to 0. So we just got back to 0% interest rates in the ECB. And so I don't know that we have any specific expectations for where the dollar could go in the short term. Over time, we would anticipate a normalization of the dollar, but our view remains it's a bigger issue for international markets right now than it is.
I think that's right. I think as these central banks around the world get in the mode that we are in, and you just mentioned one of them, that is raising rates, I think that will take some pressure off of the dollar, and we'll head back to more normalized levels.
Okay. Other questions, and I think one of the questions was, please address your allocation between domestic and international stocks, including emerging markets. And I think to that point, a large part of our underweight to international stocks, where we have very modest, and we brought that weight down back in March, is a view that the underlying fundamentals in international markets are likely to be more challenged in a slowing global economic environment.
And I would just add on to that. That's the fundamental piece, absolutely. But from a valuation perspective, the relative discount in the pricing of international versus U.S. securities has continued to widen out meaningfully, which might suggest that valuations of international equities are becoming increasingly compelling. Where we're challenged, though, does come back to the fundamental piece. We just really struggle to see what is going to be the catalyst of that positive re-rating. Ooh, it's hard to say.
Okay, great. All right. And then one more question. What are some examples of alternative investments that we might be looking at?
It is a range, of course. I would say, and whatever we do, we'd want to build a little diversified portfolio of alternatives. So take structured credit, things that cash flow almost right away. That could play a role in this portfolio, and that's actually one of the more attractive things here and now. But there is private, there's a real assets play to be made in the private markets. There's private equity, there's venture capital. I would submit there's, early stage venture, there's risk there for sure. And we probably would never make it too big of an allocation, but some of the best companies, that we know today started as venture-backed companies. And if you have the right time horizon, it can be hugely impactful in a positive way to the portfolio. So structured credit, private real estate, private equity, venture capital, those are the types of things. Long short funds can all play a role in the portfolio.
Okay. I don't believe we have any more questions at this point. So at this time, I would thank everybody for joining us this morning. If you have any questions, please don't hesitate to reach out to any of the three of us or any other member of the Heritage team. And we hope everybody has a great rest of your day and a great summer.